Hey, how you doing, econ students? This is Jacob Clifford. Welcome to the first practice exam on the Ultimate Review Packet. Now, if you don't have the Ultimate Review Packet, you need to go get it. It's amazing. It has a bunch of guided practice. It has access to summary videos and multiple choice videos, and it has a full test for your final for the AP exam. And the best way to verify if you're really getting something is to do these practice questions. So sit down, do all these questions, and look at the key. And on the key, it gives you the answer, it gives you which unit it came from, so you can go back and study if you need to, and it tells you the specific topic of that question. So if you're studying, hurry, you gotta get going quick, you can actually go straight to the topics and just go, okay, I need to study the Phillips curve and foreign exchange and monetary policy, and just do the questions that are associated with that. Anyways, I'm gonna go over all the answers right now. If you wanna skip ahead in this video, click in the description below, and you can click ahead to the different questions so you don't have to go through all of them, okay? All right, good luck on this test. Let's do this. First question, the right answer is D. Remember, the key to economics is scarcity. We have unlimited wants and limited resources. We do jump into a lot of other things, especially in macro. We talk about keeping prices down and increasing growth and all these other good things, but the main purpose of economics is how we deal with the idea of scarcity. So the right answer was D. In question number 2, it's asking about stagflation. You have to be able to use the graph to explain what is stagflation and why does it occur. And the way it happens is aggregate supply shifts to the left, right? Stagflation is the worst possible thing that can happen in the economy. We have inflation and less GDP at the same time. And the only way that's possible is if the aggregate supply curve shifts to the left, causing the price level to go up and real GDP to go down. So the right answer on this one is C. Yep. The aggregate supply curve shifting to the left is causing stagflation. In question 3, you have to understand the natural rate of unemployment, which is C, the rate of unemployment when the economy is in the long run. You should understand that this is the idea that we have 2 types of unemployment at the natural rate of unemployment. We have structural and frictional unemployment. So we're always going to have those types of unemployment no matter what. And if we have just those 2, then we're at full employment. We're in the long run, and we have the natural rate of unemployment. If we have more cyclical unemployment, the third type of unemployment, then we have a recessionary gap or something's going on in the economy that's keeping it from going up to its full amount in the long run. So 3 was C. For question number 4, the one you need to skip on here, really quickly, thank you so much for getting the Ultimate Review Packet. If for some reason you have my test, your teacher gave it to you without paying, or somebody gave it to you online or something like that, please go actually buy it. It's not just stealing from me, which it is. It's also like it's not letting me continue to produce better resources in the future. Getting the Ultimate Review Packet gets me motivated and helps give me the incentive to make more cool stuff. So other people pay in the past, and if you pay, then other people in the future can continue to enjoy it. For those of you who pay, thank you. Thank you. You're awesome. I really do appreciate it. Thank you so much for watching my videos. In question number 4 is talking about the Phillips curve and what happens when people expect higher inflation. Now, if people expect higher inflation, that means inflation is going to happen. I'm going to go to my boss, I'm going to ask for a higher wage because I expect prices to go up. Now, if that occurs, what happens on the graph? Well, the Phillips curve, E is the right answer. It'll shift the entire short-run Phillips curve to the right. A shift in the Phillips curve to the right means that price level is going to go up and GDP is going to go down, or unemployment in this case is going to go up. But the idea here is the Phillips curve shows inflation and unemployment, and anytime aggregate supply shifts, the short-run Phillips curve is also going to shift. So back in question 2, when we said stagflation is shown by aggregate supply shifting to the left, that's just like in this question saying that shows a Phillips curve shifting to the right. Now, if you're a little confused right now, go back and watch the summary video when I talked about the Phillips curve. It's really short, like 4 minutes long, explain the Phillips curve. You're totally gonna get that. But the right answer here was E. Now, before I move forward, real quick, the answer is not A or B because movement along the Phillips curve is caused by a shift in aggregate demand. So if aggregate demand goes up, if aggregate demand goes down, that's movement along the Phillips curve. But if there's a shift in the aggregate supply, that will shift the Phillips curve. So aggregate supply shifts the Phillips curve. Aggregate demand moves along the Phillips curve. In question number 5, it's talking about the balance of payments. It doesn't say that in the question, but that's the idea. And it says, if foreign investors buy government treasury bills, where is that counted? Well, that's counted in the financial account. The answer is C. Remember, there's 2 parts of the balance of payments. There's the financial account and there's the current account. The current account has to do with goods and services, exports and imports that people buy. And the financial account has to do with buying and selling financial assets. So the right answer here is 5 is C. Now, question 6 is a good question because it puts together a lot of different concepts. You got to figure out the right answer here. What causes aggregate demand to shift to the right? What will increase aggregate demand? Well, A decrease in consumers' confidence would decrease consumer spending, so not A. B, a decrease in investment spending, no, that would decrease demand. C, an increase in the price level. No, that doesn't shift the curve. Remember, a change in price level doesn't shift aggregate demand or aggregate supply. And then E, an increase in personal income taxes. No, if income taxes go up, that means people have less spending and they spend less. The only one that makes any sense is D. And D is by far one of the most important concepts in this test and on your test and on your final and on the AP exams. It's the idea of monetary policy. If the government or in the Fed purchases government securities, buys bonds, that'll lower interest rates, increase investment in consumer spending, and increase aggregate demand. Again, D is really about monetary policy. Again, one more time. If the government buys bonds or purchases government securities, buying bonds, that'll lower the interest rate, increasing investment in aggregate demand. D was the right answer in number 6. Okay, question number 7 is talking about if wages are not flexible. Now you might have known or seen your teacher explain that when you've been drawing aggregate supply this whole time, really you're talking about in the intermediate range. Really there's actually 2 other things that are happening. This thing curves vertical at one point, and down here it actually flattens out. So it really goes like whoop, like that. That's what the aggregate supply curve looks like. So the right answer here is E, the short run aggregate supply curve is horizontal. And the reason why that is when the when the price level is really low and we have a recessionary gap, wages don't really fall, and so the aggregate supply isn't really downward sloping at some point. Now, whether this is true or not is up for debate, and that's the whole idea of classical versus Keynesian, but the shape of the aggregate supply curve shows you that a really bad recessionary gap, you're gonna have a horizontal aggregate supply curve, but only when there's a recession. Maybe instead of drawing it with my hands, I'll just show you what the graph looks like on the board. So take a look. We're talking about this. Right, we've got price level, real GDP. This is the quantity at full employment, so this is full employment output. Normally we're looking right here, right? Normally we're in this zone right here looking at the short run aggregate supply curve. So as aggregate demand goes up, price level goes up. But at some point, let's talk about this side first. At some point, as aggregate demand keeps going up, you just can't produce any more output, right? We only have so many resources to produce stuff in the short run. And so at some point, all it leads to is inflation. So as aggregate demand goes up, eventually you get no more output, just higher prices. On the other side, if wages are not flexible, if aggregate demand starts falling, at some point, wages don't start going down, resource prices don't start going down, and so price level doesn't actually end up falling, right? So right down here, wages aren't flexible. That would cause just a huge increase in quantity, and wages and prices don't really fall, prices of resources, and so the price level wouldn't really fall in this range when we have a really bad recessionary gap. So not producing full employment, we're in a recession. That supply curve, that aggregate supply curve, is actually horizontal. All right, question 8, it talks about who benefits and who loses from unanticipated inflation. So when there is inflation occurs and people weren't really expecting it, who's gonna win, who's gonna lose? Keep it simple. Borrowers win. People who borrow money and inflation occurs, when they pay back that money, it has less purchasing power. So borrowers have a tendency to win. Lenders have a tendency to lose. Now, it's not always that way. It depends on how the interest rates are set up. In this one, the right answer is B. Young people are repaying fixed interest rate student loans. So if I take out a student loan of $30,000 and then inflation goes up and then I pay it off, that $30,000 is worth less later on because of inflation. So B is the right answer. All the other ones are all situations where the other people are losing because of higher inflation. Question number 9, we're talking about the production possibilities curve, which you know quite well. Understand there's only 3 places you can be on the production possibilities curve. In the curve, on the curve, or outside the curve. In this question it says, what's happening with a point inside the curve? Well, the right answer is C, a nation is using resources inefficiently, right? If you're not using your resources to the fullest, you're gonna be a point inside the curve. You're not actually producing your production possibilities. Now, a point outside the curve means it's impossible given your current resources. You can't produce that quantity of stuff because you just don't have enough resources to do it. So C is the only one that makes any sense. A nation is utilizing all its resource efficiency. No, that's on the curve. B, the nation currently lacks the resources and technology to operate point. No, it has the resources. Like the production possibilities curve shows you have the resources, but you're just not using them properly. So B, I could see you putting that, but that's not it, right? If you don't have the resources, then the curve would be lower, right? If you don't have the resources at all. But the point in the curve means you have the resources, but you're not using them efficiently. Number 10, it talks about what's most likely to increase productivity. The answer is A, a positive net capital stock investment. What does that mean? capital stock is machines, tools, and factories, and if we're investing in machines, tools, and factories, and this is the reason it says positive means there's also negative ones. Like a negative supply shock is when we run out of resources. A positive supply shock is when we have more resources. In this case, we have capital stock. We have more machines and tools. That means our workers can be more productive and we can produce more than we ever did before. So 10 is A. 10 also shifts the production possibilities curve. So if we go back to question 9, we talk about points in the curve or on the curve or outside the curve. Answer A here on this question in number 10 shifts the curve outward. Right? If we have more machines and tools, that means we can produce more than we did before. The production possibilities curve can shift outward. In question number 11, it's just an aggregate demand and aggregate supply question. You just got to be able to draw the graph. In fact, if you did this test already, you really should, and the margins are on the sides, have a bunch of graphs already drawn. 11 is just classic aggregate demand and supply. It says if the aggregate supply curve is upward sloping and there's an increase in exports is a shifter of aggregate demand, right? Got consumer spending, investment, government spending, and net exports. In this case, we're exporting more, people want more of our stuff, and that would cause aggregate demand go up. Aggregate demand going up causes price level to increase and the real GDP to increase. So the right answer here must be B, because real GDP goes up, price level goes up. B is the only one that explains this idea of aggregate demand increasing or shifting to the right. In question number 12, we're talking about supply and demand. This one's talking about a double shift. So it says, what if there's a simultaneous increase in input costs? So supply decreases at the same time that people want more of this product. So the demand would increase. Well, the result would be an increase in the price and the quantity would be indeterminate. The right answer here is B. 12 is B. Remember, their double shift rule, when two curves shift at the same time, either price or quantity is going to be indeterminate. It means you can't tell. Right? And in this situation, that's what's going on. The right answer is B. Maybe that'll make more sense with the graph. So here it is. If the demand goes up, it'll shift to the right. If the supply goes down, it'll shift to the left. And so we started here at this equilibrium and we ended at this equilibrium. Now, if you look, price goes up. Price goes up no matter what. You can't draw this without the price going up. But the quantity looks like it's the same. But really, the quantity is indeterminate. It depends on the severity of these shifts. Again, that's called the double shift rule. When two curves shift at the same time, either price or quantity are going to be indeterminate. You knew the answer was B just because you saw the word indeterminate. Like, well, that must be it automatically. Okay, question 13 is a good question. We need a graph for it, and here it is. This is the Phillips curve. We've got the short run Phillips curve, which is downward sloping. We've got the long run Phillips curve, which is vertical. I explain why they look like this in the summary videos, but let's answer this question. Which of the following is true for the short run, but not true for the long run? Well, the right answer is A. There's a trade-off between unemployment and inflation in the short run, but no trade-off between those two things in the long run. So A was the right answer. If you put B, vertical, natural rate of unemployment, that's flipped around. It's the long run is vertical, but the short run is not vertical. So B is wrong. It's upward sloping. No, the Phillips curve is downward sloping, so that's not it. There are no trade-offs between unemployment and inflation. No, that's the long run. So basically, if you messed up on this one, you read the question wrong probably. Which of the following is true for the short run but not the long run? If the question was reversed, it said what's the following is true for the long run, not the short run, then you'd have obviously different answers. And E, shift of the curve are a result of the change in aggregate demand. Shift in the curve are the result of aggregate demand. No. Remember, the Phillips curve, the short Phillips curve does not shift because of aggregate demand. It shifts because of aggregate supply. I mentioned this earlier in earlier questions. I'll say it again. The Phillips curve shifts only when there's a change in aggregate supply, right? That's it. Only aggregate supply. When there's a change in aggregate demand, that changes the point along that curve. For question 14, we're moving on to Unit 5, talking about international trade and foreign exchange. Foreign exchange, super important concept. Which of these people are going to be hurt by depreciation of the Canadian dollar, like the loonie and the toonie? The right answer here is E, a Swiss ski manufacturer that markets their products in Canada. If the dollar, or the Canadian dollar, depreciates, they're less likely to go buy other countries' stuff because their currency now is more expensive. It's more expensive to go buy euros and pesos and other currency if the Canadian dollar depreciates. So if it's harder to get the currency, it's harder to buy the products. The people who are going to miss out are the people who export into Canada. So E is the right answer here, no doubt about it. Let's go over the other wrong answers. Canadian bank holding large amounts of foreign currencies, no, they're going to win. Right? So if they're holding a bunch of foreign currency and the Canadian currency depreciates, they're going to be better off B, Canadian lumber producers who sell firms in other nations. No, that's actually gonna be good. Remember, depreciation is not good or bad. It depends on who we're talking about. If the currency in your country depreciates, that's going to be great for exports, right? More people want to buy your stuff because it's easier to get your currency. So exports would go up. In this case, in B, Canadian Lumber Company would be happy with more depreciated currency if other people are buying their lumber. C, Europeans planning on traveling to Canada on their vacations. No, they wouldn't be hurt, they'd be benefited, right? So they're going to go and get this Canadian vacation half off because they're paying less for the currency. And in D, retired Americans living in Canada, they're going to be better off, not worse off, because now they go to Canada, they've got their pension, and it goes farther because they can get more Canadian dollars for each American dollar. So the one only makes sense, the only one that makes sense is E, and that's the right answer. In question 15, we're going back to the production possibilities curve. The right answer here is D, a decrease in the size of labor force. We got land, labor, capital, those are the resources. If we have any less of those resources, the production possibilities curve is going to shift inward. It is not an increase in unemployment related to a recessionary gap. No. Remember, unemployment is not a shift in the curve, it's a point inside the curve. So if you thought, oh, well, if workers are now unemployed, that's going to shift the curve. Remember, no. Only a change in the number of resources or a change in technology can cause that curve to decrease and actually shift inward. A change in unemployment doesn't do it. D is the right answer. Okay, in question number 6, we're talking about the money multiplier, the money supply. It says if the reserve requirement goes up, remember the reserve requirement is how much banks have to hold by law. And if it goes up, that means banks have to hold more. So that'll cause the money multiplier, the amount of money that gets multiplied when banks loan out more money, to decrease. So the answer has to be C, D, or E. The money supply will decrease, right? Because now banks are holding more, and so the amount of money out there is going to fall, but it's going to decrease by less than half. So it's not going to decrease, all of it. It's not going to be no money out there. It's not going to decrease by half. It's going to decrease by less than half. The right answer to 16 was the E. In question 17, we're back to aggregate demand and supply. Short-run ag supply curve will shift to the left to a decrease in aggregate supply. Why would that occur? The answer is E, an increase in the cost of resources. Increase the cost of resources means it's harder for producers to produce stuff, means they're going to produce less. Aggregate supply in the short run is going to shift to the left. D, a decrease in price level. If you put that, no. Remember, a decrease in prices doesn't shift the curve. Price level does not shift aggregate demand or aggregate supply. It moves along the curve. And all the other ones don't make any sense, right? So 17 is definitely E. Question 18, we're putting together fiscal policy and monetary policy. The right answer here is D. Right? If we're trying to get the economy back to full employment when there's a recessionary gap, you can increase government spending, that's fiscal policy, and the monetary policy, the Fed, the central bank can buy government securities or government bonds. Now, this is the second time I've used that term in this test, government securities. Bonds, securities, treasuries, all the same thing. The right answer here was D. Question 19 is a definition question. What is investment? Investment is not buying stocks and bonds. If you put E, you're not even in a macroeconomics class. Something's going on. You're missing one of the key ideas of macroeconomics. Investment for economics, not for finance, is always buying machines, tools, and factories. B was the right answer, no doubt about it. It has nothing to do with buying real estate or capital gains or the difference between income, wages, and blah, blah, blah. I'm trying to throw you off with D and E. The right answer, of course, investment is buying tools and machines, capital stock. In question 20, it's basically asking, which one of these policies would lead to more growth, right? Why would a country have more growth compared to another? The right answer is C, large per capita government subsidies for education and worker training. Let's talk about human capital. If the workers are smarter and they're more productive, they can produce more stuff, that would lead to more growth. So C is the right answer. The main reason is none of the ones make any sense. Now, if you said E, an increase in consumer spending, yeah, that would lead to more GDP in the short run, but in the long run, it wouldn't. So more consumer spending doesn't automatically mean more growth in the long run. An increase in corporate taxes, no, that would be harder for corporations to produce more stuff, so D is out. A lower labor force participation, less workers working, that's not going to increase GDP in the long run. And the lower age of retirement means workers are out of labor force faster, so not B. C is the only one that makes sense. In question 21, it's talking about aggregate demand and supply, and most importantly about the yen appreciating. So if the yen appreciates, what's going to happen to the aggregate demand and supply for Japan? The answer is D. The aggregate demand is going to fall, aggregate supply is not going to change. And the reason why is because, remember, if the currency is more expensive, if the yen it has appreciated, it's harder for foreigners to pay for Japanese stuff because the yen costs more. So the exports out of Japan are going to cost more and they're going to decrease. People aren't going to buy Japanese stuff. D is the right answer. Aggregate demand is going to fall. Okay, in 22, which of these are going to cause the real per capita income to go down? In other words, what's going to cause the real GDP per person to fall? The answer is B, output per unit of input. If that's productivity. So 22 is saying workers are less productive. So it's a decrease in productivity. Output per unit of input is productivity. If we can't produce as much stuff, if the amount of output we're producing per resource we put in is falling, that means that that's gonna mean we're gonna produce less stuff and have less stuff for people, which means less incomes for people, and GDP would fall. So B is the only one that makes sense. Okay, question 23 talks about why countries benefit from trade. The answer is A. It allows nations to consume beyond their production possibilities curve. So if you can produce something at a lower opportunity cost than me, and I can produce something at a lower opportunity cost than you, when we trade, I can get more of it than I would if I produced myself. You can get more of what I'm selling and giving to you if you produce it than if you produce it yourself. So A works. If you put one of the other answers like E, unemployment will decrease in each of the countries, not necessarily, right? It's not necessarily going to affect the income inequality or the unemployment in different countries because there are some downsides of trade as well, right? So possibly unemployment could go up. But we definitely can get things at a lower opportunity cost than, and that's the one that counts, and that's one that works here is answer A. If you put in free trade fosters self-sufficiency, it's the opposite, and D is not the right answer. Free trade causes more interdependence between nations, not more self-sufficiency. So the right answer in 23 is A. Okay, in question 24, we got a bank balance sheet T account with the assets and the liabilities on one side and the other side. Which of the following represents the reserve ratio? Well, it's got to be 10%, right? If the demand deposits, the amount of money people put in banks was $100,000, and the required reserves right there says it's $10,000. 10,000 is 10% of 100,000, so it had to be 10,000. So B or C have to be the right answer. And the additional loans, right? So we don't have all the loans represented here because bank balance sheet has to be equal on both sides. So if money comes in, money needs to go somewhere, and that needs to be accounted for, right? So in this case, if you add up the required reserves 10 plus the securities 30 plus the loans 50, that adds up to 90,000, which is not equal to the demand deposits of 100,000. So we can loan out an additional $10,000. So the right answer in 24 is B. In question 25, we're talking about the circular flow diagram. I got a video about it. You understand there's firms and there's business. There's firms and individuals. There's the product market, the resource market, and the government. The question here is who demands the factors of production, land, labor, and capital? Who's out there buying labor? Who's out there buying capital? Who's out there buying land? The answer is firms. Firms, businesses, the ones who demand the factors of production, and they supply products. And then the individuals, they demand the products and supply the factors of production. So the right answer in 25 is B. Great, 26, we're talking about the money market graph. And if you know that graph, you know it kind of looks like this. This is the Phillips curve I showed you earlier, but we can change this to be the money market. The graph itself stays the same. All the labeling and concepts are completely different. So right here, instead of being the short run, long run, Phillips curve, all that stuff, this over here is the interest rate, the nominal interest rate. This right here is the quantity of money. This is the demand for money. And this is the supply of money. This is the graph. Notice, I just took the Phillips curve graph, erased all the other stuff, and relabeled it. Because the Phillips curve, in the short run, the long run, look just like the money market graph with the supply of money and the demand for money. So just remember those two graphs basically look the same, even though completely different concepts, entirely different concepts. So here we go, supply and demand of money. The question says, what's gonna happen when the government deficit spending decreases? Well, that would decrease the demand, right? Now there's less individuals who want demand, that's decreasing demand, and that's going to lead to lower money, that's going to lead to a lower interest rate, right? So the question said, what's going to happen to the demand for money? It's going to decrease. What happens to the nominal interest rate? Well, it's going to decrease. The right answer here in 26 is A. And question 27 is basically asking, do you understand what liquidity is? Liquidity is how easy an asset can be turned into cash. So E has got to be the right answer. Paper currency is cash. So 27 is E. An Etruscan vase might be very valuable, but it's hard to sell it, or it takes time to sell it. Money market, mutual funds, stocks, savings bonds, all these things take a little bit more time to become cash. I mean, they're an asset, they have value, but they're not cash you can turn around and go use for spending that can be used as a medium of exchange like right now today. So 27 is E. Okay, 28, which of the following is most likely to promote economic growth? We've seen questions like this before. The right answer is C, an increase in investment in tools, machinery. More machines, more growth. A decrease in business tax credits for investment spending. No, that would decrease investment spending. So that's not it. A is wrong. A decrease in federal student education grants. No, that'll do it. That's probably likely decrease human capital. Because people have less education or less access to education. So B is wrong. D, a decrease in labor force participation rate. No, that's wrong. An increase in real interest rate. No, that would lower investment. So yeah, it looks like C is the only one that makes sense. For 28, C is the answer. Okay, for 29, which of the following is not a criticism of gross domestic product? So all of these are all criticisms except for the first one, A. GDP measures only the value of final goods, not intermediate goods. Remember, the reason we don't count intermediate goods in GDP, we don't want to have double counting, right? If there's a car and there's the stock tires in the car, you don't want to separate those things out. You want to have the price of the car includes those stock tires. So A is not a criticism. All the rest of them are. GDP does not account for negative impacts on economic growth, such as pollution. That's right. GDP doesn't factor in dead fish and poor, air quality. C, GDP does not account for non-market activities. Many countries don't account for this, so GDP doesn't really fully recognize there's other things happening in the economy. D, GDP does not account for inequitable distribution. It doesn't factor in the idea there might be really, really poor and really, really rich people. GDP doesn't keep that in mind. And E, economic activities for which people are paid under the table or barter transactions are not counted. That's also a problem of GDP. There's a lot of things happening under the table that people are working, they're doing economic activity, but it doesn't count in GDP. So A is the only one that's the right answer here because it's not a criticism of gross domestic product. For question 30, we're talking about the multiplier effect and talking about the simple spending multiplier. It's the result of E, consumer expenditures rising as incomes go up. So if I spend a certain amount of money, that becomes somebody else's income, that person spends a portion of that and saves a portion, and that process is called the multiplier. Initial change in spending leads to a spending chain that expands in the entire economy. So E is the right answer. All right, so in 31, there's a 300 billion recessionary gap, and the marginal propensity to consume is 0.8. So the first thing I have to do is be able to calculate the multiplier. So if the marginal propensity to consume is 0.8, the marginal propensity to save is 0.2. 1 over 0.2 is the multiplier, which is 5. The multiplier is 5. So the question is, what could the government do, assuming no crowding out, that could get the economy to close a $300 billion gap, given the fact that they spend anything, it's gonna get multiplied times 5. So what you had to do is divide that 300 by 5. That gave you C, an increase in government spending of $60 billion. $60 billion spent in the economy gets multiplied times 5, which becomes $300 of spending, closing that recessionary gap. The decrease in taxes, you could decrease taxes, that is true, but decreasing taxes could shift aggregate demand over, could close the recessionary gap, but you got to do it by, it's actually less than 300 billion. But the point is, the B is a possibility, but the number is wrong. C is the right answer. In 32, there are 3 types of unemployment: frictional, structural, cyclical. Which one's cyclical? Well, it's C. Zelda lost a job because of a recent downturn in the economy. Cyclical unemployment is because of a recession. Let's go over the other ones real quick. A, Sue, who is unemployed, has stopped looking for a job, no longer considered unemployed, so A is wrong. Juan has taken voluntary retirement from his job. Voluntary retirement is not this idea of cyclical unemployment. D, Jack lacks the skills, right? That means he's structurally unemployed. So D is wrong. Robert quits his job to search for a better job. That's frictionally unemployed. The only one that works is C, that's cyclical unemployment. If you're in a macro class, you've got to be able to answer question 33. What is inflation? It's a steady rise in general level of prices. C is the right answer. It's not, although it does affect interest rates, that's not the definition, so B is wrong. Rise of unemployment rate is not the definition of inflation. It's clearly general prices going up over time. So in many of these questions, you just got to understand the graph, aggregate demand, supply. In question 34, same thing. What's going to happen on that graph if there's an increase in personal income taxes? So people have to pay more money to the government and they have less disposable income to spend. That means they're going to spend less. Consumer spending falls and aggregate demand would fall. The answer is B, aggregate demand shifts to the left. Again, Consumer spending, investment spending, government spending, net exports, that's the components of GDP. That determines what happens to the aggregate demand. If people have to spend money on the government or give money to government because of higher tax rates, they got less money to spend, consumer spending is going to fall, aggregate demand falls. Now in 35, we're doing fiscal and monetary policy over again, except this time it says what's going to happen to, how are we going to get long run growth, but also keep price level from going up at the same time? Well, the answer is to lower interest rates, but also to lower spending. Now why that works? Well, first of all, the right answer here is C. If the Fed or the central bank buys bonds, that'll increase the money supply, lower interest rates, and that'll increase investment spending. But increase in investment spending is an increase in aggregate demand, so price level will start going up. So how do you keep price level from going up? Well, you can decrease government spending, which would bring down aggregate demand. So if the Fed or the central bank buys bonds and the government decreases government spending, that could potentially lead to just more growth without inflation. So the answer here was C. Now question 36, it's the same skill as 35. If you understood 35, you should be able to do 36. If a country is experiencing a bad recessionary gap, what could they do fiscal and monetary policy? Well, fiscal policy, they could increase government spending, and then the monetary policy could be buying bonds or purchasing bonds. So the right answer in 36 is B. An increased government spending and the central bank can buy bonds. B was the right answer. The other ones don't end up closing the gap. A decreased government spending, that's not going to work. A's out. Decrease in taxes, but an increase in the discount rate. There's the problem. And C, if you increase the discount rate, that means it's harder for banks to borrow from the Fed, so that's not going to work. D, an increase in taxes and a decrease in the federal funds rate. Increase of taxes is the problem. You increase taxes, that's going to slow down the economy. But we're trying to speed up the economy by shifting aggregate demand. So B is the only one that makes sense. Okay, for question 37, here's the logic of this one. First of all, the right answer is B. Interest rates increase. So when you have cash or when you have money in your checking account, you could be putting that money in other places, in interest earning accounts. So the opportunity cost of holding that money in cash and having it not buying bonds is the interest rate, right? So if I could be earning 50% interest if I put my money in there, or I can keep my money in cash, the money that I could be earning is my opportunity cost. And so in this case, the opportunity cost of holding money is the interest rate. And so if the opportunity cost goes up because interest rate goes up. In question 38, we're talking about long run adjustments. So we've got an economy, the output is below full employment, so we have a recessionary gap. What's going to happen to close the gap? Well, if wages are flexible, eventually costs for resources are going to fall and aggregate supply is going to shift to the right. So classical economists suggest that if you do nothing in the economy, eventually in the long run, if wages are flexible and resource prices are flexible, aggregate supply will shift and put us back at full employment. So that's why the right answer here is C. C is the right answer for question 38. Now question 39 is asking the same sort of question as 38, except it's the other direction. Instead of a recessionary gap, now we have an inflationary gap. So in this situation, we've got the graph that says, okay, what's going to happen in the short and the long run? The short run, well, aggregate demand is going to go up from AD2 to AD3. And then eventually in the long run, wages would go up, resource prices would go up, and that would shift the aggregate supply to the left. And so the right answer is A. Aggregate demand would shift to from AD2 to AD3, but in the long run, the short aggregate supply would shift to the left, putting us back there on that vertical curve, the long run GDP. For question 40, you have to understand the loanable funds market, which is just the supply and demand for loans. It says if there's an increase in net capital inflows from foreign investors, in other words, foreign investors want to put more money into a certain economy and they want to buy more bonds and they want to basically put more money in there, what's going to happen to the market for loanable funds? Well, it's going to increase the supply of loanable funds, right? If there's the supply by people in your own country supplying money to be loaned out, and then now other foreigners got in there and they started supplying as well. So C, increase the supply, and that'll cause the real interest rate to fall. And the reason why, well, supply is shifting to the right is just going to cause the price to go down. In this case, the price is the real interest rate. So C was the right answer for 40. Okay, for 41, the rational expectation theory basically says people are rational and they'll outthink or at least predict what will happen. The right answer is B. Expected inflation often leads to actual inflation as individuals and businesses change their behavior. So if I think price is going to go up, then I might charge more if I'm a business to people because I think price is going to go up. Or if I'm an individual, I might go to my boss and request a raise because I think prices will go up. So if we think inflation is going to be 5%, it's likely that prices will go up because people are moving and making rational decisions towards that. Right? That's why it's called rational expectation theory. The right answer for 41 is B. For question 42, you have to be careful here. It's asking what's going to happen in the long run. Right? The short run, different answer. That's why a lot of these questions, you'll see it says, what happens in the short run, what happens in the long run. A lot of times you're going to get different answers here. So what happens in the short run if the Fed or the Federal Reserve or the central bank buys bonds? So they buy bonds, increase money supply, lower interest rates. So what happens? Well, that causes aggregate demand to go up. Right? And the price level would go up. So if you stop there, you're getting confused because that's the short run. Price level and quantity goes up in the short run. Eventually, wages go up and resource prices go up. And so aggregate supply shifts to the left, put us back in the long run. In the long run, GDP stays exactly the same, right? GDP does not change and price level goes up. The answer is B. Again, the reason why is because it's talking about the long run. If it asks you short run, different answers. Long run, quantity is going to stay exactly at the long run aggregate supply. For question 43, you have to know the difference between contractionary and expansionary monetary policy. Now, contractionary means we're trying to slow down the economy, fight inflation, and so you could, sell bonds. Selling bonds would decrease the money supply, increase interest rates, and decrease aggregate demand. And the point here is contractionary, trying to bring down the economy using monetary policy that would decrease aggregate demand, causing the price level and the real GDP to decrease. The right answer here is C. Right? Aggregate demand goes down, price level goes down, quantity goes down in the short run. For 44, we're actually combining this idea of balance of payments and foreign exchange from Unit 5. And it says if the Mexican peso, what's going to happen to the Mexican peso and capital flows if there's an increase in real interest rates? Now, if there's an increase in real interest rates, that means that other people would like to get those higher rates of return, right? If I'm an American, I can go buy a Mexican bond and get a higher rate of return because they have higher real interest rates. So the right answer is the value of the peso is going to appreciate, right? More people are going to buy those and that'll increase the demand for peso. So it's going to appreciate and capital flows will be into the country. So B was the right answer. The currency is going to appreciate because capital flows are going to flow into the country. Now 45 seems maybe more complicated than it is because you have the chart. It seems weird. Very easy. What's the idea of dissavings? Dissavings means there's more spending than there is income, right? There's more consumption than there is income. When is that happening? Well, the answer is A, at $1,500 disposable income. That's the only spot in the whole thing where the income is less than the consumption. People are spending more than they're bringing in income at $1,500. At $1,550, consumption's the same, and all the rest of them, all the income is greater than consumption. So the right answer here is A, because people are dissaving. They're spending more than they're bringing in. In question 46, when I'm asking another monetary policy question, I'm just driving them to death. Are you getting it? Can you do this? The answer is E. If the aggregate demand is going up and the aggregate supply is vertical and they're beyond long run, that means that they're going to start having a problem with inflation. So how do you find inflation? Well, the Fed can sell government securities, sell bonds. When you sell bonds, that's going to decrease money supply, increase the interest rate, and slow down the economy and fight that inflation. So the right answer to 46 is E. In 47, we're going back to unemployment, except now it's saying, what if someone stopped looking for work? They're a discouraged worker. Well, they don't count in the unemployment rate. They're no longer part of the labor force. And so labor force participation rate would decrease. The number of people participating in the labor force would fall. And the unemployment rate would not go up. Remember, they're not even counted as a worker anymore, so it would actually decrease. So 47 is E. In 48, we're going back to Unit 5, talking about foreign exchange. What's going to cause, or what could potentially cause, a currency to appreciate in value? The answer is B, a higher real interest rate relative to other countries. Remember, there's 4 shifters of the demand and supply for currencies. There's the price level, there's a change in tastes and preferences, there's a change in incomes, and the last one is a change in real interest rates. If interest rates go up, people are going to want more of that currency to get that higher rates because they want to buy bonds in that other country. So higher rates means more money will come in to that country. So there it is. The right answer is B. Let's look at the wrong answers. A high price level relative to the rest of the world. No, that won't cause it to appreciate. That'll cause it to depreciate because people won't want to buy their stuff. So that doesn't work. C, a decreased demand for their currency. No, that'll cause it to depreciate. D, an increase in supply of the country's currency in the world market. No, increasing supply lowers the price, in this case, the value of the currency. It'll cause it to depreciate. And E, purchase of government bonds on the open market by National Central Bank. The purchase of government bonds in the open market would drive down interest rates. So E is wrong. The only one that makes sense is B. 48 is B. For 49, which one of these things will most likely lead to an increase in growth? That's what it's saying. Potential gross domestic product is saying what is growth? Where could we eventually be? So really this question is saying what shifts the PPC, or what causes the long run aggregate supply curve to shift outward? The answer is C, an increased government expenditures on infrastructure projects. If we have more infrastructure, if we have tools and machines, we can produce more stuff. Another thing is the other answers don't make any sense. An increase in the federal funds rate would lower interest rates. That's not going to work. A decrease in cyclical unemployment. A decrease in cyclical unemployment, yeah, that would bring us to full employment, but that's not going to lead to more growth. D, an increase in inflation expectations. No, more inflation is not going to help the country have growth. And a negative net capital investment is not going to work either. So if we are investing less in machines and tools, it's not going to work in E. So C is the only one that makes sense anyways. Now for number 50, you've seen this before. This is like, I think, the fourth time you've seen this exact same kind of question, except now I'm adding some details to it. If the U.S. federal government engaged in expansionary monetary policy, so they want to expand the economy, that means they want to buy bonds. If they buy bonds, what's going to happen to the nominal interest rate? Well, it's going to fall. So nominal interest rate will decrease. The aggregate demand will increase, and then the unemployment rate is going to decrease. Unemployment rate would fall because now we're producing more stuff. The right answer for number 50 has to be B. Great. For 51, a decrease in government deficit spending. So if the government borrows less, what's that going to do? Well, it's going to decrease the nominal interest rate. So 51 is the right answer. 51 is B. And the reason why is the federal government's not going to be borrowing as much anymore, so it'll decrease nominal interest rates. The other ones don't make any sense. For example, it'll cause price level to go down, not up, so D is wrong. And it'll likely increase unemployment because those jobs no longer exist because the government's not doing that hiring in E. Again, this is the idea of the government borrowing affecting interest rates. In this case, they're borrowing less. The opposite of that is the idea of crowding out when the government borrows more and it causes the interest rates to go up. So if you understand crowding out, you should understand the reverse of crowding out, which is this, question 51. For question 52, it seems like there's a lot of math, but you're going to get it here. Daniel has a gross income increase of $1,000. So he has $1,000, but it told you the government takes 20%. So he really only has $800. Of that $800, he's going to save some and spend some. How much he spends? Well, 75%, right? The marginal propensity to consume is 0.75. So of the $800, he's going to spend 600 of it. So the right answer is B. He's going to save the other 200 of it, right? Because he spends 75% of the $800 and he saves 25% of it. So the right answer is B, 600. In question 53, we're talking about the multiplier again, but now it's the money multiplier. It's 1 over the reserve requirement. The reserve requirement just told you is 10%. So 1 over 0.1, which in this case is 10. 10 is the multiplier. If the government is using contractionary monetary policy, that means they're decreasing the money supply. So you knew the answer had to be C, a decrease of $10,000. 1,000 times 10 is a decrease of $10,000 when you use the multiplier effect. In this case, the money multiplier. 53 is C. Okay, in question 54, it's talking about the velocity of money. And you need to understand the quantity theory of money, right? The amount of money we have out in circulation times the velocity, how much that money is spent and respent, equals the nominal GDP, the price times the stuff we're actually producing. In this situation, it says the real GDP, or the GDP deflator, equals 200. So you understand the deflator is kind of like CPI. 200 means prices increased 100%. It's like the GDP increased 100% between this time period. And it's saying that the velocity of money is constant. So how can you get double the amount of GDP to go up? Nominal GDP goes up double. How's that possible? Well, the answer is the money supply must have gone up double. So the answer is A. If you're confused here, don't be. It's a funky worded question that explains the concept. All you gotta understand for the concept and for the quantity theory of money is the idea that if the loss of money is the same and the quantity we're producing of stuff is the same, the only way you increase the money supply, if you increase the money supply, all you're going to get is an increase in prices by the exact same amount. So if the loss of money, the amount of stuff we're producing stays the same, then if you increase the money supply, double it, you're going to get double the prices. In this question, it just said double the prices. Prices doubled. Well, what must have happened? Well, we must have doubled the money supply if the loss of money stayed the same. Question 55 is your classic comparative advantage question. The best way to set it up is by setting up one of the charts I showed you in the Unit 1 summary. Also, you can use the quick and dirty for this, but let's go over the right answer. The right answer is C. Country X has a comparative advantage in corn, while country Y should specialize in comparative advantage in scooters. But why? Well, first of all, you got to set up the chart. And you got to cross out some things because you understand that A is wrong. Country X has an absolute advantage in production of corn. That's not true. Country X produces only 2 tons of corn, and Y produces 5 tons of corn. So country Y has an absolute advantage. So that's it. Remember, absolute advantage is really easy to find. It's just who can produce more of something with output questions. In B, country X has an absolute advantage in production of corn. No, also wrong. Country X does not have an absolute advantage in the production of corn. A and B are out of here. D, country X has a comparative advantage in the production of both goods. That's also out of here because you can't have, in these questions, a country that has a comparative advantage in both. So you only got C and E are the only ones that make any sense, and C is the right answer. Country X has a comparative advantage in production of corn because they have a lower per unit opportunity cost, and country Y should specialize and produce scooters because they have a lower opportunity cost for scooters. E doesn't work either because trading 1 ton of corn for 8 scooters, 8 is too high of a number. You need that number to be lower than 5 to make it work. So C is the right answer for question 55. 56 is another one of those questions about unemployment. This time it's about structural unemployment. Structural unemployment means the workers don't have the essential skills. They're going to be replaced by robots, which is the right answer. C, workers, is replaced by machines that are cheaper and more productive. So C was the right answer. Structural unemployment means that the structure of the labor force has changed in such a way where those jobs have become obsolete, or those skills have become obsolete. So C works. A worker is laid off during a recession. No, that's cyclical unemployment. B, a worker voluntarily quits his job. No. A worker is denied a job training, on-the-job training. No. A worker switches from part-time to full-time. No. E doesn't work. C is it. Workers replaced by machines. That's structural unemployment. Okay, now we're back to Unit 1 again, looking at the production possibilities curve. If we're currently at point D, what'll give us more growth? Well, more growth can be done with more capital, more machines and tools and factories. So if we move to point B, that will lead to more capital. The right answer here is C. Now, if you thought, which of the following changes would foster future growth, just moving from PPC2 to PPC3, that does show growth. The movement and the shift outward of the production possibilities curve shows the idea of growth. But it's not asking that. It's asking what could lead to growth. Leading to growth could be producing more capital. Now, you knew that from previous questions, right? Producing more capital stock, more machines, tools means we can produce more. That's economic growth. This is showing it to you on the production possibilities curve. So the right answer is 57 is C. And in 58, I already gave you the answer, right? The shifting outward in the curve shows economic growth has occurred. So B is the right answer for 58. Shifting the production possibilities curve 2 to PPC 3, that shifts out the curve. Shifting out the curve means growth has occurred. So there it is, 58B. In question 59, we're going all the way to Unit 5, talking about foreign exchange. If the price level is higher in Canada, then what's going to happen in the foreign exchange market? Well, the answer is D, depreciation of the Canadian dollar. So it's D for 2 reasons. So first of all, people in Mexico aren't going to want to buy Canadian stuff because it has a higher price. So that means they're not going to buy their currency, so their demand for the Canadian currency would decrease. So that would cause the currency to depreciate. So demand would fall for Canadian dollars. At the same time, Canadians wouldn't want to buy their own stuff because it's so expensive because of high inflation. So they're going to supply more of their dollars in the foreign exchange market, also driving down the value of their currency. So in both cases, whether it's a decrease in demand or an increase in supply, no doubt about it, the Canadian dollar is going to depreciate. The answer is D. 59, D. And the last question of the test, really fast, easy one, nominal interest rate is 10%. If people expect inflation to be 3%, then the real interest rate would only be 7%. So the answer is C, 7%. And the reason why is, if you're expecting and you're planning on getting 10% return, but inflation goes up 3%, then you're only going to get a 7% real increase in return. It talks about the difference between real and nominal. Now, thank you so much for watching these videos. I really do appreciate it. Thank you for getting the Ultimate Review Packet. I hope you did well on this test. Remember, I gave you the units and I gave you the topics of each one of the questions, so you can go back to the summary videos and go back over them and check it again. There is a second test, yes, a second test on the Ultimate Review Packet, so you can try it again. The 60 multiple choice questions for the second macro test. Again, thanks for watching. Please subscribe. Until next time.